Hi, Augustine. How you doing?
Hello, I'm good. How about you?
Good, good. You ready to roll with chapters? I guess we're up to what, chapter 3 and 4, right?
Yes, yes, yes. Sorry,
All
because I
right.
gotta put the volume up because I could barely hear.
Okay, hold on a second, then. All right, let me dig this up. I thought I had it already.
All right, now it's working.
There you go. Chapter 3. Now we start talking debits and credits, boy. Okay. Hi, Simon.
Hello, hello.
Welcome aboard here. We're just getting started.
All good, all good.
Do you see the screen, Simon?
Yeah, I do.
Okay. The reason I checked is sometimes I forget to put the screen up and I look like a dummy babbling. You guys are looking at a
It's
blank
all good.
screen.
It's all good. I'll let you know if that happens, but I'm sure
Please,
we'll be
please
fine.
do.
Absolutely.
All right, let me just do one other thing here. Okay, the double entry framework, huh? Double entry accounting. It means you have to have at least one debit and one credit in every transactions, every transaction. Let's look at a T account, which we've done earlier, I believe.
Hmm.
T account. Maybe we're seeing this for the first time. This here mimics the general ledger. This is the poor man's general ledger, what we're looking at here. I just need to kill this device. And you can see it's shaped like a T, right? And then you see the words debit and credit. Debit and credit means simply left and right. So it means left and right. Debit's on the left side, credit's on the right. Left and right's all it means, okay? One is not better. Debit is not better than a credit. There's no value judgments here. And then the T account is left and right. And that's the typical abbreviation, okay? Hey, the word cash just appeared on top of the T account, guys, okay? You have one of these T accounts, if you will, for everything in your chart of accounts. Think of them as a folder where we're going to accumulate data and come up with balances of these different accounts, okay? So Carmen is joining us. Hi, Carmen. Are you there, Carmen?
Good afternoon, Bob.
Hey,
I'm
how you
here.
doing?
I'm
We're
doing
just
well.
getting going here. I'm going to back up just a little bit, Carmen, real quick. All we just talked about what's called a T account. It looks like your general ledger. You'll see the words debit and credit. Debit and credit, it just means left or right. That's all it means, left or right. And they're showing you the abbreviation. And here's where we were when you dialed in, Carmen. Cash. You're going to have one of these T accounts for cash and accounts receivable and accounts payable and rent expense and phone expense, insurance, inventory, whatever you can think of that you want to cover in your general ledger, you're going to have one of these accounts. And the trick is being able to work with the debits and the credits, okay? Every T account has an increase side and a decrease side. And to confuse you further, some accounts increase on the debit side and some increase on the credit side. The debit side is always on the left, the credit's always on the right. Sometimes it can be an increase or it could be a decrease depending on the account. And this is where it gets a little bit tricky, where you're going to have to do your homework and try to get as comfortable as you can working with debits and credits. Putting and balancing a T account. Here's cash, right? Cash, I'll give you a hint. Cash is an asset. Assets go up on the debit side. Assets go up on the debit side. Cash is an asset. So here, they had an inflow, if you will, of cash. Cash went up 2,000, cash went up 500, 570, 430. And then during the month, they also spent money. They spent 1,200, 300, 200, etc. The total debits, which is the increase side, totals 3,500. The credit side totals 3,130. The balance is going to be the difference between the two of them. And that balance is going to be $370, okay? And you write the balance on the side with the larger total. High man wins, right? So I don't think that's too tough, toting up a T account in your general ledger. Describe the effects of debits and credits on specific types of accounts. Uh-oh, here we go. The debited account means you're entering the number on the left side. To credit on the right side, huh? Debits may increase or decrease the balances of specific accounts. Same thing with credits. So let's take a look at your first rule, okay? Assets. What are assets? Anything of value owned by the company, right? Cash is our favorite asset. Accounts receivable, representing the number of dollars your customers owe you at that point in time. Inventory, prepaid insurance, prepaid supplies. Those are all assets. Land, building, equipment. You get the idea. The key thing here is assets go up on the debit side. They are reduced on the credit side. Liabilities are the opposite. If our accounting equation is assets equal liabilities plus equity, and assets go up with a debit, liabilities have to go up with a credit, okay? So if we want to increase the balance of a liability, we have to put it on the credit side. Liability is a debt. It's money we owe to people, right? It's an IOU. Liabilities, assets equals liabilities plus owner's equity or owner's capital, if you want to use those words. Capital increases on the credit side. Capital increases on the credit side. Okay. Hi, Audrey. Is Audrey there?
Hi.
Hey, how you doing?
Yes. Hello. Good.
I'm
How
just
are
gonna-
you?
Good. We got a good crowd today. I'm just going to back up a couple of slides, Audrey, get you up with the group here. We were just talking about
Okay,
the
thank
world
you.
of debits and credits.
Okay.
There's a T account. You see assets. Assets increase on the debit side, meaning left, and decrease on the credit side. Assets go up. If you debit the item, goes down with a credit. Liabilities are the opposite. Liabilities, if you want to increase the number, you put it on the credit side. And then the capital account. Again, it goes up with a credit. And there's no other way to learn this, but work at it a little bit. Do your homework until you're comfortable with what's a debit, what item is a debit balance, what's a credit balance, okay? When we say, for example, guys, when we say an asset has a normal debit balance, that means the side of the T account that increases it, okay? So assets are normally increased with a debit. Liabilities and equity are the opposite. Let's introduce three more things, really, two more things. Revenue. Revenue represents sales. Sales, you can see here, increase on the credit side, just like liability and capital accounts, okay? Revenues go up on the credit side. Therefore, expenses, which are the opposite of revenues, go up on the debit side, okay? So if we get the electric bill in the mail and we say to ourselves, oh, this number looks correct, I'm going to record this. When we enter it into our accounting computer, we're going to tell the computer to put it on the debit side to increase it, okay? Where you have revenues, here's a little hint that might help. You will never, ever debit a revenue account. You're never going to do it. And you're never going to credit an expense account. So maybe that tip will help a little bit. And then finally, there's something called withdrawals, drawing. And after the first 3 or 4 chapters, after your first test, you're never going to see this again. This is a situation where the boss takes money out of the business for his or her personal use. Obviously, for a small company, the boss comes out and says, hey, Simon, do me a favor. Will you cut me a check for $5,000? And you say, sure, boss, what's it for? And she'll say, well, I'm taking the kids to Disneyland this weekend. Well, then you know it's not a business expense. It gets categorized in what's called a drawing account, withdrawals, and it reduces your equity. So drawing goes up with a debit, okay, which has the impact of reducing equity, which normally goes up with a credit. There you go. 6 things to get under your brain. And I guarantee you'll be struggling with it for a little bit because everybody does. It's just the way God made this, okay? Here is a screen that might be helpful to learn it. Assets, debit, normal balance, liabilities, normal credit balance. And what do I mean by normal? I mean the side, left or right, that increases the number. Owner's equity goes up with a credit. So does revenue. Revenue goes up with a credit, and you're never going to debit revenue. How about that? You never debit revenue. You never debit sales. Expenses go up with a debit. You never credit expenses. Just not going to happen, okay? And then drawing is the oddball that you're not going to have to worry about after your first test. Drawing has the impact of reducing the owner's equity, okay? I think this grid here is the easiest one to work with. I wouldn't go anywhere past the first column here. Just look at the increase side. That's all you need to know. If you know what the increase side is, you automatically know the debit side. Assets increase with a debit, liabilities and capital and revenues increase with a credit. Expenses go up with a debit, and so does drawing, okay? If you look at it, it's not that overwhelming. It's 6 things, but you're going to have to think about it because it's somewhat counterintuitive. This stuff doesn't lay itself out in an apparent linear, logical fashion. The debit and credit rules are set up specifically. And I'm going to tell you this bad joke I tell every semester. There was a guy who worked for 50 years in accounting, right? And he went to work, and every morning he opened up his desk, and there was a little cabinet there, and he had a key. He opened it up, and there was a little piece of paper about this big. And he would look at the paper and study it for about 10 seconds, and then he would put it back. He retired after 50 years, right? Well, they wanted to know what was on that piece of paper. So after he retired, they opened up his desk. They looked at the piece of paper. You know what it said? Debits on the left, credits on the right. Haha, I'll let the laughter stop. My point being, it's not going to take you 50 years to memorize this, I hope, okay? Now, we're going to go through the same transactions we did in chapter 2. And I was working with Carmen on Sunday, and we used words like increase, decrease, higher, lower, more or less. We're not going to use those terms anymore. We're going to talk accounting. We're going to use the term debit and credit to indicate an increase or decrease. Keeping in mind, a debit can be an increase or a decrease. Same thing with credits. And they're giving us this business about how we should look at things. What happened? Make sure you understand what just happened. It sounds simple, but you got to think about it a second. You sold something. You sold something for cash. Well, you know, cash is going to go up and you have revenues going up, but you have to be smart enough to say we have to debit the cash to increase it and credit the capital to increase it. So let's see what we have here. Mitchell Williams opened up that delivery business of his where he's delivering pizzas all over the Santa Barbara. He invested $5,000 in the business. Identify the accounts that are affected. Cash obviously goes up. Capital goes up, right? But we're not going to say increase or decrease. We're going to say you debit cash and you credit capital. And now you're seeing it in T account form, okay? This looks different than chapter 2, where we were just introducing you to the accounting equation and keeping it in balance, okay? So right now we're in balance, 5,000 cash, 5,000 equity. He bought a motor scooter for cash, and he calls it delivery equipment in his chart of accounts. So delivery equipment went up and cash went down. So we are going to debit delivery equipment, credit cash. Take a look at it. He now has an asset worth $2,000, but he used cash, $2,000 worth of cash. So his cash balance at this point in time is $3,000, okay? Purchased an asset on account. He bought more delivery equipment, but he bought it on account. When you see those two words, guys, on account, say to yourself, on account, and nobody had money. There's no cash involved in the transaction because you're going to pay it off later. It's either going to be accounts payable or accounts receivable. So Mitch bought a second motor scooter for $1,800. Is that accounts receivable or accounts payable? Guess what? It's accounts payable because we're the ones who have to make the payment. The company that sold us the motor scooter, they call it accounts receivable because they're the ones who are going to get the money. So we have to increase the delivery equipment and we have to increase accounts payable. Accounts payable is the number that we owe to our suppliers at that point in time. So we're going to debit delivery equipment. We're going to credit accounts payable. And here we go. We brought in another asset. Our assets are now up to $6,800. They were $5,000, right? What changed here? Accounts payable went up $1,800. Capital remains the same, and we're in balance. Now we're making a payment on that $1,800, huh? We owed $1,800. We owe $1,800. Now we're going to pay $600. So what are we going to do? We're going to see, as soon as you see the word paid or payment, you know that's cash. You know it's a credit to cash, and it's going to be a debit to what? Accounts payable. A debit to accounts payable reduces it. So here we go. We debit accounts payable for $600. That reduces the debt to $1,200. We credit cash. I'm sorry, I got happy fingers for some reason. We credit the cash for $600, brings the balance to $2,400, and now we're still in balance, okay? Assets go up with a debit. Liabilities and equity go up with a credit. Okay, we finally sold some product. We delivered some pizzas, and we did it for our cash customers. Mitch made deliveries and received $2,100 in cash from clients. Identify the accounts that are impacted here. Well, he made a delivery. That's what he does for a living. That's revenue, right? Revenue. He now has a sale. And he got cash. It was a cash sale. So we're going to debit cash and credit revenue. So here's the debit to cash for $2,100. And over here is your credit to delivery fees, $2,100. Notice that they elongated the owner's equity section. Here you just saw the word capital, right? Capital is impacted by these 3 items here. 4 items, really. Owner's equity, if somebody puts money in the business, that's called contributed capital. That's capital, okay? Somebody puts money in, capital goes up. The owner withdraws money, capital goes down. The business is worth less by the amount of the drawing. Revenues automatically, you see that nice plus there? Revenues, credit side, revenues automatically increase capital, expenses reduce capital, okay? So we're going to be learning pretty soon that these are the 4 components of owner's equity. We paid for the rent. Rent. I think rent is an expense, don't you? So we have an expense called rent, and we paid cash. Expenses increase on the debit side. Increase on the debit side. We debit rent expense. We credit cash $1,000, okay? Paid the phone bill. Same exact thing. We're recording an expense and then we're paying for it at the same time. So we're going to debit phone expense and credit cash. Debit phone expense, credit cash. Okay? If the business, if the month ended right now, this company would have a profit of $2,100 less the $1,000 and the $100. They'd have a profit of $1,000. So this guy's doing pretty good so far, huh? Delivery revenues earned on account. On account if nobody had money. There is no cash involved when you see the words on account. You're giving the customer credit. That's how the business world works. You know, trucks don't deliver big loads of steel and soda to stores or whatever, carrying suitcases full of $100 bills. Everything is done on credit. You order something and then you get a bill in the mail, which you later pay with a check, right? So delivery revenues aren't on account. Revenues go up and accounts receivable is going to go up, huh? Not the cash. Take a look here. Debit accounts receivable. There is a new account you're seeing for the first time, huh? Accounts receivable. That's how much our customers owe us at this point in time, okay? 2,400, and we credit revenue right here. 2,400, that increases the sales, the delivery fees, whatever, to 4,500, okay? Notice that we're never going to put a debit on the delivery side. We're never going to debit the revenue, and we're never going to credit an expense. That ain't going to happen. Purchase supplies for $80, okay? And these supplies are going to last a couple months. Since we're going to generate future benefit. That's a fancy way of saying supplies are an asset when you buy them. It becomes an expense when you use them, okay? And you'll be learning about that like crazy in a couple of chapters. So we bought supplies. We have a new asset. We're going to call it supplies, and we're going to credit cash. We're going to debit supplies expense, or not supplies expense. We're going to debit supplies, which is an asset at the time of purchase, because we're going to use it in the future. So anytime you buy supplies or you buy insurance, they're assets, not an expense at that point. And we paid cash for it, $80, okay? We exchanged one asset for another. We gave $80 in cash for $80 worth of supplies. Cash receipts from prior sales on account. Let's back up then. Let's look at our accounts receivable. How much is the balance? $2,400, right, guys? $2,400. What happened a few days later? We received $1,900 in cash. Mitch received cash, but this transaction doesn't affect revenue because the revenue was already recorded when he made the delivery. Revenues and expenses are recorded at the point of the sale. It has nothing to do with whether or not cash changed hands. It's called accrual-based accounting, and that's what we're teaching here. Okay, he received cash. Well, cash goes up with a debit, and accounts receivable, which is also an asset, goes down with a debit. So the balance now in accounts receivable went from 2,400 down to 500, right? And he got a nice check in the mail for $1,900, okay? Cash, that's our favorite asset. We love cash. But accounts receivable is pretty darn good to have too, as long as you have an expectation of payment. Wow, here's a tricky one now, huh? We bought an asset on credit. As soon as you see the words on credit or on account, it means no what? Yeah, no cash. So let's see what we have here. Bought a third motorcycle for $1,000. He made a down payment, though, of $300 and spread the remaining payments over the next 4 months. So we have 3 accounts to worry about, huh? He bought another piece of delivery equipment for $1,000. He credited cash to reduce cash, and he credited accounts payable to increase accounts payable. He now owes $700. So let's see what we have here. He bought another motor scooter for $1,000. He paid $300 in cash. That was a down payment demanded by the seller. And we credit accounts payable to raise it now up to $1,900. Okay? Debits and credits. He bought an insurance policy. When you buy an insurance policy, it is an asset at that point. Okay? It is an asset. Insurance policy, you buy an insurance policy in December of 2022 to cover the year of 2023. Well, you spend $12,000 for that policy, but in December, it's an asset. it's going to be it's going to be doled out month by month as an expense in the future year. Okay, so we bought an asset and we used an asset to pay for it, cash. Another exchange of assets, insurance, cash. Payment of wages. This is an expense, don't you think? Wages, huh? Expenses, we debit wage expense to increase it, and we credit cash to reduce that asset, okay? Let's take a peek at it. We debit wage expense, and now this guy's got some expenses adding up here, huh? And there's the cash we used to pay for it. Here we go. Now we delivered something for cash and credit. As soon as you see the word credit, you know there's no cash involved for that portion. But we did get some cash receipts in this transaction. Total delivery fees amounted to $3,500. 900, I can't see that, 900 in cash, right? Yeah. I can read that. 900 in cash, 2,600 on account. So let's think about this. Well, the revenue is the 3,500. We record all the revenue. It doesn't matter if we've been paid or not. So we're going to increase the revenue. Cash is going up by 900. That's good. And the balance of 2,600 was on account. On accounts receivable, because we're receiving the money, okay? So let's look at our entry. We debit cash for $900. That asset went up. We debit accounts payable for $2,600. That went up. We credit $3,500 here to revenues. That credit increases revenues, okay? And then the last transaction we'll look at is a withdrawal. And like I said, you're not going to worry about this after the first test. I wonder, though, if you ever go out in the workforce and you're working in the office and the owner comes out and says, give me a couple $1,000, I'm going to Europe. I wonder if you'll remember how to handle that, huh? So here's how you handle it. You debit the drawing account, which is called Mitchell-Williams drawing, and you credit cash. Look at what we did here. We debited drawing, which goes up with a debit. It's called the contra account. It's a capital account that actually has the opposite balance. And there's a few of those in accounting, and you'll get used to those. But the point is, if you debit an equity account, and these guys here are equity accounts, you're decreasing the owner's equity. So the owner's equity went down by 3,000, huh? So there's the debit to reduce the owner's equity, and there's the credit to reduce cash, okay? Prepare a trial balance, explain its purposes, okay? Hey, we did all these transactions. Now the month has come to an end. And at month end, companies prepare their financial statements. They're going to prepare an income statement, a statement of owner's equity, and a balance sheet. And they have to be done in that order, which I'll demonstrate. Let's start, though, by preparing what's called a trial balance. What's a trial balance? It's simply a listing of all of the accounts in your general ledger. It starts with cash, accounts receivable. It goes in the order of assets, then liabilities, equity, revenues, and expenses. And you'll get used to that right away. What this is going to do for us is just tell us that the accounting equation is in balance, okay? In the year 2023, I can't imagine there's going to be a computer system that lets you post an out of balance entry. If you tried to do it, your system will stop you. So I don't think you're ever going to run into this problem. Unlike the days years ago, you know, it makes me feel pretty old. Thinking back that I used to do this in pencil back in the old days. And I got an invitation coming up in a year to my 55th high school reunion. That makes you feel pretty old too. Double entry accounting. Prepare a trial balance, double entry. It just means you have to have one debit and one credit in a transaction. You can have one debit and 100 credits, or one credit and a bunch of debits, okay? The trial balance, you're going to do this at month end. It's not a financial report. It's a worksheet. It's a piece of scrap paper. It's just going to prove that the debits equal the credits. No one in the history of finance says, I want to see your trial balance. Trial balance doesn't mean anything. It is a good tool, though, for preparing the financial statements. What order does it go in? I just told you, assets, liabilities, equity, revenues, and expenses. Finally, we get to see a trial balance. Notice it goes in order of assets, one liability, accounts payable, then capital, we get two capital accounts, revenues, expenses. And we're dropping the numbers in, 470, 3,700. Where did we get these numbers? Did they just make them up? No, we computed those numbers. Look, our cash balance at the end of the month was 470. Balance in accounts receivable, 3,100, etc. 470, 3,100, 80, 430, 470, 3,100, 80. So that's where these balances came from. Now we're able to prepare the financial statements. You see where it says delivery fees? That's your revenue. I would get in the habit of taking a pen or a marker and putting a horizontal line right between drawing and delivery fees. Why do I suggest doing that? Because if you do, everything below that line is your income statement. Everything above it is your balance sheet. You don't even have to think. Here they're breaking it out for you a little bit. The blue represents assets. The yellow liabilities, capital is the purple. Drawing is that more plum type color. You have a green color for revenues and that red color for expenses. There's breaking them out. Let's look at the financial statements. Look at that income statement. You have a heading, the company name, Mitchell Campus Delivery, income statement for the month ended, and that's important. Make sure you say something like for the month ended, or for the month of, or month of, okay? That's important, and you'll see why in a moment. You start with the sales. They have only one type of revenue, delivery fees, and they only had those three expenses. Remember the $1,650 in wage expense, the $1,000 in rent, and the $100 in phone. Those expenses add up to $2,750. $8,000 in sales minus $2,750 in expenses yields a profit, a net profit or net income of $5,250. Now, you might recall I said you have to do the statements in the proper order. You must do the income statement first. You have no choice. Here's why you have to do the income statement first, because you're going to take that $5,250 right there, and you're going to bring it down to the second statement, statement of owner's equity. Let's take a peek at this one. Again, you say for the month ended or month of or something, okay? This is not that tough if you think about it a little bit. We are going to say The beginning balance was 5,000. I'm calling that the beginning balance. Beginning balance was really zero. But we're going to say 5,000 was the beginning balance. That's the money he put into the company to start. That was our first transaction. So you have a beginning balance of 5. What was the net income? 5,250. We bring that down here and we're going to add that to the equity because net income increases equity. But he drew out $3,000. You recall that? That reduces equity. So the change in equity is the difference between the 5,250, I guess, and the 3,000, gives you 2,250. 5,000 at the beginning plus 2,250 equals 7,250. So this guy had a good month, huh? He had almost 6,000. Well, he had $5,000 in profit on sales of 8,000. He got a return of about 62% on his money. That's pretty darn good, wouldn't you say? And in so doing, he increased the value of the business on paper anyway from 5,000 to 7,250. Okay. Statement of owner's equity. Beginning plus income minus drawing equals ending. Okay. Now, finally, we're going to do the balance sheet. The balance sheet is a representation of the accounting equation. Assets equal liabilities plus equity. Look at your balance sheet. Well, let's see, we had assets, cash. There's our famous 470, 3,100. Our assets happen to add up to 9,150. Accounts payable is 1,900. But the capital is no longer $5,000. It's no longer $5,000. What did it grow to? 7,250. You bring that down and we're in balance. Okay. And guess what? That's the end of part 1 for today, okay? Any questions? Any comments? Nothing, huh? Is this a Carmen? Is
Oh,
this
it's
helpful a little? Oh, I'm sorry. Go ahead. Who is that?
all good. No, no questions. I've been writing
Okay.
things down as we go, but I'm gonna study
Okay.
more on it.
Okay. Let me just run into the bathroom for about 1 minute, okay? And I'll
Sure.
be right back. You guys can discuss it among yourselves now, okay? I had to get myself a bottle of whiskey. Okay, let me try to call up the other PowerPoint for chapter 4, okay?
Sounds good.
So what do you think? You have the debits and credits memorized yet?
Left and right.
It's really just 5 things.
Yeah.
Assets, liabilities, equity, revenues, expenses. But it's gonna drive you crazy for a little while.
Oh, no, I don't doubt it.
Okay. Do you see the screen? Anybody? Somebody tell me they see it?
Yes, I can see it.
Yeah.
All right. Okay. Chapter 3 introduced us to debits and credits. And we did some transactions, and you saw those transactions go into your general ledger. General ledger are the books of the company, right? The Bible. Here in chapter 4, we're going to talk about the mechanism that updates the ledger, okay? And we're going to learn about something called journal entries. And you need to be experts in journal entries as well. Journal entries are how you enter things into your computer system for eventual posting into the general ledger. So let's take a look here. They're talking about describe the flow of data from source documents to the trial balance. What do they mean by source documents? They mean a piece of paper. They mean paperwork. A source document can be an invoice. It can be a sales ticket. It can be a receiving report from downstairs on some good you got into the business. It could be a copy of an email or a printout of a text. Usually there is some kind of paperwork involved with every journal entry, okay? And what is our cycle? Well, we kind of know this already, I think. We have to input the data. We have to come up with the proper debits and credits. And once we know what the proper debit and credit is for any given transaction, we are going to enter those into the general ledger. So during the course of a working day, you might have to do 3 or 4 journal entries, depending on the business. And you go into your computer system, whether it's something like QuickBooks or something bigger like Oracle or Mass 90, say. You go in and you say, I want to debit this account, I want to credit this account, and you even have a little row there to explain why, what you're doing, which is important. Well, at that point, you have not updated the ledger. All you did was create a file for later posting. So maybe your policy is at the end of the day, you go back to your computer and you look over the general journals. Journal entries are what they're called. Journal entries or general journals. You look them over and you say, these are correct. I'm comfortable with them. You hit the button called post on your machine. As soon as you hit the button called post, everything goes into the general ledger and can never come out. If you make a mistake, the only thing you can do is write a correcting journal entry. You want to reverse out the error and then put it in correctly, okay? So you can never white out anything in the general ledger. And then once we've got the general ledger updated, all the postings are done, we're ready to prepare the trial balance and the financial statements, okay? Source documents, we're back on this again, huh? Source document, check stubs, cash receipts, cash payment records, sales invoice. You could think of a million of them, right? You know, it could be the copy of a text. Your boss is on the road, and the boss says something like, "I just had lunch with a customer, and I spent $500, which I took out of our company ATM just now." Well, you're just going to print that out, and you will debit the appropriate account, travel expense or entertainment expense, and credit the cash. Describe the chart of accounts as a mean of classifying. The chart of accounts. It's a list of all the folders. Think of these things as folders. It's in numeric order, and it's used to determine which accounts are affected by a given transaction. So here it is. This chart of accounts, like all chart of accounts, go in the order of assets, liabilities, equity, revenues, expenses. Every account in your chart of accounts is going to have what's called an account number. It can be as simple as you see here, 101, or it can be very long. For example, when I worked at the neighborhood clinics, Santa Barbara neighborhood clinics, which is, a small operation, we had just one for, say, cash. That was it, 101. When I worked at a bigger company, we might have had a longer account number. We might have had 101, which meant cash, and then it was -02, electronics division, -1133, California. You get the idea. They can be quite long. But what they have in common is assets will always start with a 1, liabilities with a 2, and then 3, 4, and 5 for equity, revenues, and expenses. That's universal. Journalized transactions. Now we're seeing this for the first time. What's a journal? A day-to-day listing of transactions, provides the record of the transaction. Referred to as the book of original entry. For some reason, that question pops up on the test a lot. True or false? The general journal is the book of original entry. Yes, it is. And it's typically a 2-column piece of paper, which you're going to see here. And we're going to put in a date and the title of the account and the amount, and importantly, a description. So here we go. You ready to go over these transactions again? This time we're going to do them with a journal entry. Mitchell opened his business, huh? So we know we're going to debit cash and credit capital to increase both of them. Here's what the journal entry looks like. This is the form. Okay. Here is a completed journal entry. So let's take a peek at it. This is what your computer system is going to look like. You're going to go in there and you're going to type in a date. And maybe you put the year at the top one time. You don't put the year over and over, but your book says you're supposed to do that. I never saw that in my own working world, to be honest with you. But what do? We debit cash. We go to the debit column and we not post yet, but enter the $5,000. We credit capital. And we credit capital on that credit side. And then it's very mandatory to have a very, very brief explanation. And 99% of your explanations can begin with these 2 words: to record. My explanation, if I was doing this, I would have said to record owner investment. Okay? The reason you write an explanation down, is that over the course of a year, when the auditors come in the following year and they pull out a transaction from the ledger, you're not going to know what that transaction is necessarily because you don't remember everything you did. So they tell you that it's journal entry number 1. You find journal entry number 1, and now you look at it and you see the explanation. That's one reason. But there's another more important reason you might find interesting. As you get into more and more complicated transactions, you might have trouble writing a brief record explanation. If you have a real problem with that, it's an indication, guess what? That your entry may be wrong if you can't put it into simple terms, okay? Very important here. You notice the credits are indented. That is 100% universal. If you flushed it up, you didn't indent it, it wouldn't be wrong, but you'd be telling the world that you, A, maybe don't quite know what you're doing, or B, you're a little rude because that's how auditors and readers of these things expect to see the journal entry, okay? And then you skip a line between the journals. A compound entry simply means an entry with more than one debit or more than one credit. That's all. So let's take a look at some journal entries. Here we go. Remember we bought the supplies for $80? We decided it was an asset, huh? We debit supplies. We credit cash. We reduce the cash. We increase supplies to record purchase of supplies. We received money from a couple of customers, totaling $1,900. We debit cash. We credit AR to record cash received. We bought a motor scooter, which required a $300 down payment. So we debit delivery equipment. We credit accounts payable, because that's the amount we have to pay in the future. And we credit cash, because we had to cut a check before the guy would give us the motor scooter. Here, we bought an insurance policy. Your journal entry, you debit insurance, credit cash to record insurance payment. Wages expense, we debit. Credit cash to record salaries. And here is the one where we sold something partly on credit, huh? We sold $3,500 worth of pizzas. That's a credit to revenue. We did get $900 in cash right away, and the balance of $1,600 is sitting in accounts receivable. And then we had the drawing. The owner came in, took cash out of the business. Drawing is not an expense. That's a question they love to put on the test in different ways. Drawing is not an expense. It is a reduction of the owner's capital, okay? It's a reduction of your business's equity. Now, it's time to post, ladies and gentlemen. We've done all those transactions. We did them from A to M or P or whatever it was, right? The earlier chapter. Now it's time to post them. We're going to post them to the general ledger. The general ledger, those are the books of the company. That is where the auditors are going to start their work. The auditors are outsiders. They come into your company and they review your financial statements and your procedures and policies, and hopefully they issue an opinion that tells the world your financial statements are in good order based on the information that they got, okay? So the general ledger is a complete set of accounts similar to T accounts. And you're going to keep a record of the debits and credits in each account, as well as the balance in the account. And the ledger goes in the same order as the chart of accounts. Start with cash, accounts receivable, then liabilities, equity, revenues, expenses. T accounts were introduced previously. However, businesses will use the general ledger account, keeps a running balance. So here we go. Here's what you saw in the prior chapter, right? Cash, a T account. You might remember me saying it's the poor man's general ledger. Well, there's your cash, 5,000, 2,100. Here it is in the general ledger. Once you hit the word post, once you hit the post button, it created all of this. So here's your first folder, cash. It's account number 101. And your first transaction, 5,000, a debit here. Then B, or then you had B, 22,000, 2,000 rather, and then 600. You get the idea? You started off with 0. You opened the business with $5,000. It brings over a balance of 5,000. You spend 2, the balance goes down to 3. You spend 6, etc. So the balances go up and down, up and down, up and down. And when you're done, by definition, you should have a debit balance, in this case, $470. You cannot have a credit balance in cash. You can credit the account all you want to spend money, but at the end of the day, you have to have a positive balance, otherwise known in this case as a debit balance. What happens if it's the end of the month and you run the trial balance, and the first thing you notice is you've got not 47,000 here. We'll make it a bigger number, huh? It's not 47,000 debit, but it's like $47,000 credit. Well, you got a problem. The most benign explanation, hopefully, is this. Oh, well, we didn't record the last day's receipts. We'll do that now and catch up with it, okay? Or somebody made a mistake, which you can correct. But if either of those two explanations don't take hold, you might have a real problem. Maybe you're floating checks. Have you ever done that in your life? Bad habit, bad habit. I've done it in the past, in my younger days. I have no money in my checking account, but I write a check for $300, knowing I get paid on Wednesday. And hopefully I can get that 300 deposit in to cover that check. Businesses are not supposed to do that. It's probably illegal. It's certainly unethical, but they do it and they get in trouble. Okay. The worst scenario is somebody stole money. Okay. At the end of the month, we got minus $100,000, and you check everything, and someone says, Carmen, hey Carmen, Carmen's in charge of the cash. She'll know what to do. And you go to her office and you find out that Carmen has quit the company and moved to Nicaragua. Pretty good possibility. Carmen stole the money, right? But I digress. The process of copying debits and credits is the posting. You enter the date of the transaction, the debit amount, the balance, maybe a posting reference perhaps, and the ledger account. Take a look at it. Here is our general ledger. We debited cash, we credited capital, and here's the general ledger. We hit the button called post, and immediately it shot that arrow right there. $5,000 debit into the general ledger, okay? And again, the trial balance, we know what this is now. It's just a listing of all the accounts with their balances, be they debit or credit. And all it does is tell us that we're in balance. That's all it does. But it also gives us a good worksheet to do the statements. And again, everything after drawing is your income statement. You can look at this in 2 seconds and say, well, they had 8,000 in sales, they had about 2,600, 27. Well, you already know they made about $5,000 net profit. I'm not going to go over this too much. Explain how to find and correct errors. Even though the trial balance says the ledger is in balance, it could still be 100% wrong, right? A journal entry was made debiting or crediting the wrong account. An item was posted to the wrong account. Maybe you had the electric bill in your hand, but you absentmindedly debited salaries and wages expense by mistake. Well, your trial balance is still going to look good, but it's wrong. And it can happen from various mistakes like that. So it's important to be careful preparing the journal entries. I think we know that. And post them. Take your time. Tips for finding errors. I'll let you look at this on your own. This is you'll learn these tricks. Divide the difference by 2. That might help it pop right out for you. But here's the one I am going to talk about, because I used this a lot in the old days. And even though you're using computers now, you still are going to have the opportunity to use the difference by 9 trick, okay? Here we go. If the difference is evenly divisible by 9, you probably have what's called the transposition error. You took a number and you transposed it. Slight error, let's look at the transposition here. The amount was 250, right? But you entered it as 520. The difference between 520 and 250 is 270. What's notable about 270? It's divisible by 9. 36. You entered it as 63. Difference is 27. It's divisible by 9. 85 minus 58 is 27 again, okay? 81 minus 18 is 63, divisible by 9. Now, why do I tell you this? Because you will be working with Excel spreadsheets like crazy, and you're going to take a column of numbers and you're going to list them all down. Maybe you have a list of employee names that you have to enter and a dollar amount for some reason. And then you go into the next column and you enter numbers, and the 2 columns are supposed to equal. Well, they don't. They don't equal. You're using a computer. Yeah, but you throw garbage in, you get garbage out with a computer, right? If you do this divide by 9 trick and the number is divisible by 9, you might be able to just take your finger and rapidly run your finger down the screen and come up with the difference. It is a nice help, the dividing by 9. If that doesn't work, double check your work. Correcting errors. You never erase in the general ledger. And you make it in a way makes it easy for others. A new entry must be made to correct the accounts. I would criticize that by saying, make the correct entry only after reversing the wrong entry. And they're giving you an example here, which I don't like, but we'll look at it. Assume that a $400 rent payment for rent expense was incorrectly debited to repair expense. That's an easy mistake to make, huh? Well, we got to get the $400 out of repair expense and put it into rent. And that's what they're doing here. They debited rent. That makes the rent expense correct. And they credit the repair expense, which brings it back down to 0, where it should have been in the first place. This method will work, but you can get in a lot of trouble if you're doing some correcting entries that also impact the ledger and the income statement. Believe me, you want to reverse the bad and then put in the new. Out with the old, in with the new. Hey, chapter 4, that was a pretty quick one, huh? Who's got questions or comments? What do you think, Carmen?
I think I'm getting it like while I'm here and you're explaining it to me, but once I'm actually doing the work, it tends to be a little hard on me. But
Yeah, yeah. Well, welcome to the club. That's not just you. That's probably most of the class. Like I said, it's
Me
not.
too.
There you go. Simon agrees. You are not going to pick this up immediately. The world of debits and credits drive students crazy for maybe a couple of weeks. You just have to get comfortable.
right.
Now, if this was an in-person class, the first test I would hand you, in addition to a computer test, if you're given one, I would hand you a piece of paper with about 25 accounts on them and some columns. And I expect you to be able to tell me if it's an asset, liability, or equity, revenue, expense. I expect you to tell me what the normal balance is, debit or credit, and I expect you to tell me what financial statement they go on. So we got some learning to do, huh?
Lots of learning to do.
And I'm here on Sunday evening for tutoring. That's my main gig now. 5 to 7 on Sunday. Anybody want to join us? You're okay, Simon?
Yeah, I'm all good.
All right. Hey, Augustine, how you doing? Did you fall asleep the whole time I was talking?
No. I was just on mute, yeah. Because mom's doing noise in the back, so I don't want to be loud.
I could see you. No, I'm only kidding.
Yeah.
Okay. All right, let's call it a class, okay?
Okay.
I will I'll try to get this video on the module, okay? If I
Okay.
have trouble doing that, I'll just put an old video, Bob's greatest hits, okay? Hey, you guys all take care. We'll see you next week or see you
Thanks,
Wednesday,
Bob.
right?
Take care, yeah.
Hey, bye-bye, guys.
Bye.
Arr.